Mike Sanchez.
And I'm Eric Howard.
We're interviewing thousands of people to learn how they manage their finances. Talking about money's super awkward. We're trying to change that. The more open we are about our finances, the more we can learn from each other and improve our own. This is Safe Space Finance, a place for honest and inclusive conversations about money. Okay, so welcome to Safe Space Finance. Today we have the one, the only, Katie Griffith.
Oh my God. I was joking. That's too funny. You just had that ready.
We like to introduce all of our guests and get them hyped, get them loose, because, you know, talking about finance is a little personal and you need to kind of, you know, loosen up a little bit, you know?
Totally.
Okay. So, Katie, if you don't mind, just maybe introduce yourself so everyone can kind of get to know you a little bit.
Sure. Hi, everyone. My name's Katie. I am right now in Washington, D.C. I grew up in this area. I grew up outside of D.C. in Northern Virginia. I am the daughter of two military officers.
Ooh.
My mom was, I was like, I could go deep and talk about my mom and dad, but I won't. But since we're talking about finance, I will say that they used the military to pay for college and for like a lot of their life expenses, which then influenced the way they saved and the way we talked about or didn't talk about money in the house. I am one of three. I'm the middle child. I went to school at Radford University in lovely Radford, Virginia, in Southwest Virginia. Yeah, it's a state school.
Awesome.
And I got a degree in design. I started out in business and took a design class just for fun. I missed like my art classes from high school, so I did it for fun and kind of fell in love with it. And they were like, if you want to keep doing this, you're going to have to declare it as your major. And I was like, no problem. So signed up for a fifth year. I had to extend my time in college. Darn. Did a fifth year, graduated with a degree in design and minored in business. And I came back to the DC area. I graduated in 2008. So it was like the recession. It was like peak recession. Everybody was getting fired. Super fun. So I very fortunately got a job. I kind of like went into healthcare by way of design. I worked for an architectural firm in DC. My first and only client with them was Kaiser Permanente of the Mid-Atlantic States.
Shout out to Kaiser.
Woohoo! KP baby. A side note, did you see like 75,000 nurses or clinical workers just went on strike at Kaiser?
Oh, no.
It's like the largest union strike. I know. I'm like, oh God. Anyway, I hope they don't work it out. Yeah. Anyway, so I worked at Kaiser. I started out on the design team. They were building a bunch of new medical centers, and it was so fun. I was very fortunate to like fall into like a lifetime project, 5 of them really, as such a newbie. And the internal consultants that project managed, that were responsible for getting the buildings activated, each project had like a transition lead, and they were kind of like the conductors of like all the pieces. The internal stakeholders, the external stakeholders, the docs, the like local EMT. And I thought what they did was so cool. So when they had a position, I applied and was fortunate to join the team. And that's kind of how I got my foot in the door doing healthcare consulting and healthcare planning, which is where I met Mr. Michael Sanchez. So yeah, I stayed at Kaiser for 9 years, and then I moved into planning for VA at a consulting firm in DC. And then 2 years ago, I decided to take a big old career leap and leave the corporate world. And I now work for a small design firm in DC doing residential interior design program management, which has been a huge shift and change and challenge in many ways, but it's like so fun. It was basically like that. I'm going to go make less money, but I'm going to like love doing it. And it's been a
Mm-hmm.
blast. So that's what I'm up to now. I think that gets us up to speed. That gets us up to 2023.
Yeah, I think it does. I mean, like, to be honest with you, I've always like I'll never forget the day I remember like I was walking like behind my house and I was in the alley behind my house and I was like, well, what are you gonna do, Katie? You were like, well, I'm gonna go work at a design studio, and it was just such a foreign concept for me because like
Mm,
I've spent my whole entire life in consulting, and I just
mm,
like for someone to leave consulting and then be at a design studio, I was just like, whoa, like I can't compute. But now, I mean,
mm.
I have such respect for you because you just did it. You're like, no, no, I'm good,
Oh,
and, and you did it.
well,
So
I did it.
and
I will say that it was definitely calculated. There were a lot of spreadsheets involved and pro con
okay,
lists.
okay, okay.
I'm
So
still
you,
a consultant, so there was a
I see.
PowerPoint and a spreadsheet minimum.
Okay, okay, okay.
Yeah.
Well, that's awesome. And one thing I really like about that is like you didn't let like money guide that decision. I found that really unique. So that's cool. You're basically in DC and you are at this design firm. Um, what sort of financial goals or life goals had you had sort of in the past? Maybe things that you've achieved, and then sort of things that you want to achieve in the future.
hmm so a couple years back, the big goal was to buy a house, which I did in 2019.
Congrats.
Thank you. This is my tiny little old house, but I love it. And that
I
was a
mean,
couple
DC's
years.
not cheap.
Yeah, she ain't cheap. She's 100 years old, but she wasn't cheap. So yeah, that was the big goal, was to buy the house, and I did. And I'm like, I'm slowly fixing her up, project by project. So yeah, that was the biggie. And then in the future, I would love to be able to save up again, or like be in a situation where, because I eventually will go back to the real world, the quote real world, because I'm still young and I still have a lot of years ahead of me, hopefully, knock on wood. Um,
Yeah.
so I would like to save up to have the freedom to be able to work for fun and work for enjoyment. I
Yeah.
also would, if we're being honest, I would really like a beach house situation,
Okay.
or like to move to the beach. Like those two
Mhm.
things could be the same, like maybe I get into a
Yeah.
situation where I can move to the beach and just work there. Maybe
Yeah.
like in the in season and then travel in the off season. Doesn't that sound like
Mm.
the dream?
I mean, it does sound nice. It definitely sounds nice. Like, are we talking about the West Coast or the East Coast when you talk about the beach, or is it either?
Either. Right now, I
Okay.
would say
Okay.
East Coast, just because my family and friends are mostly here.
Mm-hmm. Mm-hmm.
But yeah,
Okay.
I wouldn't say no.
Well, I mean, that all makes sense to me. So you've got a nice little plan for yourself. I mean, first of all, you've got a house in the nation's capital, which is very difficult to do. A super competitive market. In 2019, it was definitely competitive still, and you've basically been able to pull that off. I am kind of curious, like, how did you pull that off? Like, how did you like?
hmm
How were you able to buy a house in like Capitol Hill, super expensive neighborhood? How did you do that?
hmm Yeah. Well, it starts back like with my parents. One, and growing up, like I grew up very privileged, and my parents saved very conservatively. Um, I thought all money was supposed to go into retirement. Like the concept of investing for like short-term investments was never spoken of. I didn't even learn really about it until college, and then get serious about it until like my late 20s.
Mm-hmm.
Um, so I didn't have, I came out of school with no debt. So I just want to say, like, I know that that's not everybody's situation, and I'm so grateful for it. My parents did a VPEP. It was a Virginia prepaid college plan back in the
Oh, okay.
80s. Shout out 80s babies. But it basically was like they paid, it was like $5,000 for 4 years. The
Wow.
last time, yeah. And it was basically, the agreement was if she goes to an in-state school, this pays for 4 years of tuition. Anything outside of that, you can cover, but like this will pay for a Virginia State tuition in the
Wow.
year that she goes. Yeah. So I was very fortunate. My parents like hooked me up back in 1988. So I graduated from school with no debt, which was amazing. I started saving very conservatively. In 2016, I learned about, I feel like, I hope other people listening will like relate to this. I used to, and still do to a certain extent, I get really anxious when I would approach, like, I know this is important, like investing in my own personal finance, but I don't really understand it. So I would like kind of approach it and then I'd be like, I'll figure this out another day. So I finally sat down in 2016 after I had one of my best friends worked for Hello Wallet. I don't know if you remember.
No.
Have you ever heard of Hello
No.
Wallet?
I need to get educated. Hello Wallet.
I think it was bought by another company, but it had to do with investing. And he told me about robo investing. And he was like, because I was telling him, he was like, oh, where's your money? And da 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 da. I was like, I don't know. Please stop. I don't know. Like, I don't like thinking about it. It stresses me out. Like, I know it's important. I want to be better about it, but I just don't even know where to start. And so, yeah, he introduced me to robo investing, and I did some research and went with Wealthfront, and I opened that in 2016. And I'm sure everybody who listens to this and is friends with you probably already knows what it means. But for the one person out there like me who didn't know.
Please.
So yeah, rather than paying a personal, like a personal and
like a financial advisor, kind
Thank
of
you.
human
Thank
being.
you.
Yeah.
Exactly.
Yeah.
Rather than paying a human being to invest your money, you take a quiz and on a website or an app, and it rates your risk tolerance, and then it will diversify your portfolio for you. And you just give it cash. Like, I just give it cash and it invests it for me. And when he told me about it, I was like, perfect. That's exactly what I just here. I have money. Can you please do something better with it than it's sitting in my savings account, which was the case. Go ahead.
What time? Just out of curiosity, what year was that? Like, what year did you open that thing?
I opened it in 2016, but he probably told me about it, honestly, like 2 or 3 years before that. It took me a while to like get comfortable, which I don't know if that's normal, but it was what happened for me. It took me a while to like get comfortable with changing what I was doing.
Yeah, like
I like comfort
yeah.
and safety.
Yeah, no, I get it. I completely get it. You know, you got money in your checking account, you got money in your savings account. It's super secure. And you know you got bills to pay. There's no gymnastics to pay bills. It's just all sitting there. And then like I mean, I know that when you know, you open any sort of brokerage account, they ask you for all sorts of information. They have to ask you for your social security number. They have to ask you for your routing numbers for your bank and all that kind of stuff. So it is a little scary, even just the process of doing it. But it's awesome that you found, like, you kind of you went for it. You know, you just said, well, it's time. I've always been curious about how people sort of start investing and who they get advice from. But it sounds like you had some good counsel from, you said it was somebody from Hello Wallet?
Yeah, his name's Paul. He's gonna crack up. Yes, Paul, and his wife works for Motley Fool. Do you know what I'm talking about?
Yeah, I know exactly what Motley Fool is.
Okay.
I'm looking up Hello Wallet right now, and it says Hello Wallet is an online and mobile application for employees founded by former Brookings Institution scholar Matt Fellows. based in Washington, D.C.
Yeah, it was a
Interesting.
startup when he started there, and he loved it, and he would talk about it all the time. So yeah, that was kind of like the topic kept coming up. He was somebody I trusted. Yeah, him and his then girlfriend, now wife, were both like financially kind of not driven, but focused and educated. So yeah, I trusted them. I trusted my brother he manages all of his own finance, but because he's my brother, when he's like, you should do this, I automatically am like, no, I want to figure it out myself, which is like, I mean, I'm an adult. I should figure it out myself anyway. But yeah, it was to answer your question, how I got there, it was like a slow process for me, but yeah, listened to people I trusted, did some research on my own. And then I feel like I started off slow. Like I didn't pump thousands and thousands of dollars in like right away, you know?
Yeah. When you were likely working at like Kaiser, so you're probably like gainfully employed at the time. Did you set up automated recurring investments at that time?
No.
Like, did you set up an automated, like, pull from my bank account this amount every month or every week or something like that?
It's an option, but I don't do that. I've always managed it manually.
Has anyone ever suggested to you to do the more automated investing style?
Not a person, no.
Okay.
The emails do, and they're like, you should set this up. You should buy this credit card, sign up for this credit card, and you should do this, and you should do that. And I'm like, I don't know. No, thank you. Yeah. I like, because I'm like learning and I consider myself sort of like a novice, I like, if logging in and doing it myself is my way of being hands-on, like, then I'll take that one step. You know what I mean? If
Yeah, that
I
makes
had
sense. Yeah.
If I manually would go in and, you know, invest in it monthly, but I didn't want to set it up to occur automatically, because then it's just being removed again. And I'm like trying to get more involved.
Yeah, I actually I like Wealthfront's like concept a lot. They have like they have tax loss harvesting, which I find is like a really cool concept. They're able to sort of offload investments where you've lost, and they realize a loss for you, and then they switch that investment with another investment that tracks a different index, and it basically allows you to claim a loss against your taxes. And they I think you can claim up to $3,000 a year in losses, which offsets either your capital gains or your actual income, which is really cool. Do you by chance have a sense for what you're invested in? Because it's a robo advisor, right? But ultimately it's picking investments. Do you have a sense for like what the actual investments are that are underlying your portfolio?
So the percent split, when I took the quiz, I took the quiz and it ended up being fairly risk tolerant. I don't know. I should Google it. So I have 35% in US stocks, 25 in foreign, 19 in emerging markets, 10 in divided growth stocks, 6% in municipal bonds, 5 in commodities, and 0.3% in cash. And then when you drill down into those, it does tell you what makes up those.
Yeah, let's hear those. Let's hear what's actually
Sure.
underlying, like, so US stocks, for example.
US stocks has a Vanguard total stock market ETF and an iShares core S&P total US stock market ETF, as well as another Schwab US broad market ETF.
Okay.
So
okay.
That's US. I haven't looked in some of these in a long time. I looked at commodities the other day because I was like, have you heard that Bill Gates thinks water is going to be the next like big issue? Like he called pandemics being one of our weak points, like our biggest risks in the US. And he says the next one's going to be water. So.
Oh, wow.
That sucks. Because if you haven't heard, water is life. Shout out DC Water. In foreign, it's got another Vanguard and another Schwab product.
Okay. So basically like the underlying investments are ETFs that are, so ETFs are exchange traded funds, and they're ETFs from a variety of sort of outfits. So you've got like some Vanguard, you got some Schwab, you got some iShares. And I imagine that what's happening is they have like a portfolio of those things, and they swap you in and out of those things to do the tax loss harvesting. So if you like right now, we're in a down market, not a down market. We're like up 8% over the year kind of thing, generally in the stock market. But the past few months have been downward. And I'm imagining that they probably sold some of your stuff. And then so like, let's just say in the US total stock market one, they probably sold like the Vanguard one and then bought up iShares. And that was what allowed them to do like tax loss harvesting or something like that.
Yeah, it's sporadic. I get emails when that occurs, and they're like, hooray, we harvested your tax loss. And then at the end,
they tell you the amount. They like actually say like, we just saved you like $46 or something like that.
They used to. Now you like log in, and if you want to like run a report or like go look at it, you can. They don't put it in the email anymore. But yes. And then at the end of the year, when you do your taxes, you obviously pull it, and then you can, like you said, you can deduce it from your income,
from your total income or
capital
your capital gains. They charge an advisory fee for their services. Do you know what it is?
It's last time I looked, it was 0.25%.
Okay.
Yeah.
Okay.
Go ahead. Oh, I was just going to say, I remember when I was looking like back in 2016, and I was trying to figure out what I wanted to do. That is like so much lower than if you were to work with a human. So that was one of the selling points for me. I was like, if they're kind of doing the same thing, I think I will just, go this route.
Go with the robot.
Go with the robot. Sorry, humans.
I think like generally speaking, most places where you would get an advisor who's a human being, it will run you like in a more, I think, affordable lane. It might be 0.5% of your entire portfolio value, up to 1% of your entire portfolio value. And so 0.25%, it is better than what you'd probably get with a human being. So that's like, if you had $1 million portfolio in that year, you'd be charged $2,500, which is not that steep of a charge for having $1 million in your portfolio under management. So that's pretty cool. Has your overall experience with Wealthfront been positive? Like, have you ever had any issues or needed to contact customer service, had any like problems with them?
Oh, no. It's been fine.
All been easy breezy?
Pretty easy breezy. Yeah. I was going to say, I don't use it a lot. You know what I mean? Like, I will make transactions to like put things in, but like to make big transactions, so like big withdrawals, I don't do that frequently. So like, I haven't had that much experience to like, be able to say, but no, in my few years now, it's been fine. Great.
I mean, I think it's serving its purpose because like technically when you're doing long-term investing, you don't really want to be active about it, right? Like the whole point of having a pseudo advisor, like a robo advisor, is so that you aren't actively worrying about it all the time. If you were actively worrying about it all the time, it'd kind of like defeat the purpose of having it being sort of managed for you. The one thing I will say is like you have, it might be good to consider doing a monthly or a weekly kind of shoe into that. And the only reason I say it is because there's this concept called dollar cost averaging. And in essence, all it means is that if you want to, if you want to mirror the performance of the market or the portfolio that they've designed for you, then you need to invest into it at a frequent cadence so that you can mirror the performance. Because if you only invest on, like let's say every quarter or something, you're hitting the market at certain snapshots in time, and you might not be capturing the full upside of the market as well. So you could be catching just downside, you could be catching just upside, you could get lucky. But if you want to mirror how the portfolio is designed to perform, then dollar cost averaging would allow you to do that a lot easier. And if you're uncomfortable doing like a larger amount, you could just start with like a smaller amount, and that would help too. But it's just a concept called dollar cost averaging that most people would say is like the easiest way to do passive investing, and sort of make sure that you're mirroring the portfolio performance that's designed for you. Interesting.
Okay, yeah, thank you. I'll look into that.
So you've got this taxable account at Wealthfront. I'm proud of you because you're doing it, you're investing,
Thanks.
You're earning money, making your money work for you, which I think is super powerful. Do you also have retirement accounts? So like, do you have I'm sure you have 401ks because you worked at a bunch of places, but like, let's talk about IRAs for a second. Do you have traditional or Roth IRAs?
I do. I have a Roth IRA and a traditional IRA. I contribute to my Roth IRA annually, and I have not. The only reason I have a traditional IRA is I was a 1099 a long, long, long time ago, and I used it then, and I haven't touched it since. So I do have both. One is used more frequently than the other, or contributed to more frequently than the other.
The Roth IRA is kind of just sitting there. You're not, like you said, you're not investing into it. Mainly you just invest into your Wealthfront. That's like your main investment vehicle right now. Right?
I contribute to the Roth at tax time. When, you know what I mean?
I see.
Where it's like once a year it asks you, how much did you contribute to a Roth account? I'm like, right. And you have until like April 15th to invest. That. So about that. Every April 14th, good old Katie invests in her Roth.
Okay. And are you contributing like the max? Like for example, this year it's like 6,500. Or are you kind of just picking a number and just doing it?
No, I'm pretty consistent about doing the max. If I don't, I'll do somewhere near it, like 6 or like 55.
Okay. And then, so where is your Roth IRA? Is it at like a Fidelity or Vanguard? Where is that?
Both the Roth IRA and the traditional are with Fidelity.
Okay. So you've got Roth IRA, traditional IRA at Fidelity, and you've got your taxable at Wealthfront.
Yes.
And do you by chance know what your Roth IRA is invested in, since you do like contribute to it each year?
It's in a Fidelity like targeted 2050 account.
Okay, a target retirement. Yep.
Targeted retirement 250.
Target.
With a lot of initials behind it. And I'm like, great.
Okay. Got it. Okay. So you got a target retirement date portfolio and it's 2050. Is that the date that you plan to retire?
Mike, I would love to retire from like corporate America earlier than that. And then later in life, still work. I don't ever see myself like just stop working altogether. But I would like to work for enjoyment and maybe not work full time.
Yeah. The only reason I was asking is because a lot of people, they find comfort in the target retirement date portfolio. But I notice what some people do is they push back the date from their real date so that the portfolio remains aggressive even as they near retirement. Because what usually happens with those things is they change the allocation proportionally from stocks to bonds. So it's like you have more stocks as you're younger, and then it turns more into like bonds and closer to cash holding things. So if you push it out, so you say like, oh, 2065 or whatever the latest date you can get to is, it'll stay aggressive for longer, which will mean that you'll probably have higher returns for a longer period of time. And then it'll slowly make that transition. So that's, if you want to stay in that sort of target retirement date situation, you could do that and just make it slightly more aggressive and work for you a little harder if you just push it out.
Smart. I love it. I will definitely do that. Pro tip.
Okay, so you've got so you were at two healthcare consulting firms, and then you were at a design studio. So you've been at 3 different places. Do you have 3 401ks?
Yes. I have 1, 2, 3. I have 3. That's correct.
3 401ks. Okay.
Do I have
and
more?
So
1, 2, 3, 4. I have 4.
You have 4. Okay. So, okay.
I have 2 from
Walk me through that.
Kaiser. I have 2 from Kaiser. They
You
have
have 2.
Yes, because I was vested in a severance because I worked more than 5 years.
Okay.
So that's an account.
Okay.
And then I have another 2050 targeted retirement account. Those were 2 from Kaiser. I have a one from Guidehouse. I wonder if it's like safe that I'm just spilling my entire, it's already on LinkedIn. It's fine. And then I have my current one.
Okay.
So yeah.
Okay.
4.
So you got 4 retirement accounts. Have you ever considered rolling any of those over into any of the other ones by chance?
I remember last time I left, I have looked into it and I just got overwhelmed because I don't really understand like what they're asking and like what the risks or what the penalties are. So I just like let it sit, which I have no idea if that's a good or bad, average, atypical thing, but that's where I'm at.
Yeah. I think what I've heard mostly is that it's like the real fear is that people will forget that they have a 401k at a place. And so they literally just leave. They leave their 401k somewhere and they don't know where it is.
Oh no, I won't forget. No. I won't forget the money. I just don't know. Yeah, I guess I just don't know what does it mean to like roll it over? Is that good, bad, same? Same?
So I think in general, what most people look at with 401ks is fees. So you can open each one of those accounts and you can look at your transaction history and you can look at your fees. And different brokerages have different fees. Different employer group plans have different fees. And so if, let's just say, I mean, just for sake of argument, you have 4 different accounts. And likely you're probably paying, you said what?
No, go ahead. I do have 4. I think.
Yeah. So you have 4 accounts and you're more likely than not paying fees every quarter on each account. Let's call it $5 or $6. So you are paying that $5 or $6 4 times over when you could be paying it once. If you were to consolidate all those. So in essence, you're losing money on fees because of how you're set up. There are definitely some implications of like rolling over your 401k, especially if like certain investments that you're sort of positioned into at one 401k are not available to you in the other 401k. That can cause some issues as well. So what most people do is wherever they are currently, they like talk to that, that employer's brokerage firm, and they say like, hey, I've got one over here, one over here, one over here, one over here. Can you tell me like what the implications are? Usually you can just call them up and just ask them, and they can walk you through it. And And then if it is complex and you don't feel like you're confident about it, you can always ask like a CPA about it to see if there's any sort of taxable event. Because I think that's the main thing you want to avoid is like, oh God, you don't want to have to deal with any sort of taxable event. I think sometimes they'll send you like a check, and then you have to invest that check within 60 days to avoid a taxable event. But rollovers can function in a variety of ways. It just depends on sort of what's available to you. So the main thing I would be thinking about is like, are the fees crazy? Because you definitely don't want to, when a portfolio is just sitting there and you're not continuously investing into it and you're losing on fees, you're just sort of eating away at it. And that can hurt you. So it's worth looking into.
Is there a fee for moving it? So if I asked them to roll it over, well, one, do they do that for me? Can they do that for me? I wouldn't want to get the check in the mail because doesn't that, like, you can only pull your retirement money out early once, right? Otherwise you get penalized for it, I think.
So
I don't know.
It wouldn't count as taking a withdrawal if you reinvested it within the time frame.
In another 401k like product or whatever?
In exactly another pre-tax 401k product. It has to be like a like product.
Oh. Are they going to tell me that? Because I won't know, and then I'll do something wrong, and then that's why it sits and I don't do anything.
Yeah, they should tell you.
Okay.
There are other options, right? Like some people roll 401ks into their traditional IRA. So that's another option. So like if you want to get out of that game, you can roll it over into some other traditional IRA. Some people do roll over their 401ks into Roth IRAs. I don't suggest that for you because it sounds like your 401ks are all pre-tax. They're not Roth 401ks. But you would want to look at either rolling it over into another 401k or rolling it over into, I think, an IRA. And it's all very common. So I imagine that they would have somebody at whatever brokerage firm your current 401k is with, and they'd be able to tell you sort of, here's how that could work.
Okay. How many 401ks do you have? Just out of curiosity.
So I have my old 401k from my previous employer, and then I have my current 401k. I did roll over one of my 401ks, but I have my prior 401k is at Vanguard, and I still have a lot of my taxable stuff is at Vanguard too. So I have like a lot of stuff there. So I just wanted to keep it all in one place. I did look at the fees. I'm paying like $5 a quarter kind of thing on my prior 401k, and it's similar to the fees I'm paying here, but I just didn't. I felt like it was so negligible. I was like, whatever. Do you have any sort of tips or any advice? Like if you were talking to your younger self about this, is there anything that you would encourage your younger self to do? Is there anything that you would encourage other people like you to do when it comes to this stuff?
It would have been to get in way earlier and to not be so nervous about asking questions. Just, I wish I had gotten into it earlier. I learned about time value of money. It like blew my mind. I just wish I had known all of this a lot younger. Yeah. And to not be so afraid. Yeah. To both make a change and to ask for help. Yeah.
That makes sense to me. It's the same way I feel. Well, I mean, I think you've got a lot of good stuff going on. I mean, you act like you're ancient, but like you're still fairly young. So, I mean, you have some time left. And I think if you do start, like aggressively dollar cost averaging, you will build a portfolio. Have you ever used a compound interest calculator to see like what your portfolio will have in like 30 years or something like that?
Wealthfront will do that for you. So,
I love it.
Yeah, it'll tell you if you continue on this track if you continue
Mm-hmm.
this similar behavior, you'll have X
Mm-hmm.
amount of dollars at 67.
And does that number like
Oh, I'm like,
make
why
you
isn't it
go like
more? It's like a couple million. I'm like, no, more, more, more. Just kidding. I
got
would
it.
be very, very happy with that.
Yeah. I mean, it is tricky, right? Because it's really difficult to understand how retirement does look, because one, inflation is like wild. And then
Uh-huh.
two, you look at the prices of homes and it's like well, not skyrocketing, but interest rates are skyrocketing. And then the prices aren't really going down.
Mm-hmm.
So you kind of wonder, like, I keep thinking about what if my daughter, like when she's in college, she like moves to the West Coast and we need like I think we would want to be like closer to her.
Mm-hmm.
So if she like started working there and it seemed like that was where her life was going to be, like we'd want to like go over there. But then like how much will that cost? That's like the year
Oh.
20, let's call it 2044.
Mm-hmm.
Like how much will that cost for us to go find a place to be and live on the West Coast in the year 2044? And
Yeah.
how much is that going to balloon our expenses? Like how much do I really need?
Yeah, that's why I think I say more, 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 because who is even to know? Because, like, okay, you said West Coast. Even if you look at like LA, San Francisco, like the out migration patterns of cities are changing. So,
Mm-hmm.
who even, like, when you say West Coast, where is she going to go? What will real estate even look like there in those locations? I'm
Mm-hmm.
also concerned about, like, I like to work, I want to work, but, um, not that like robots are going to take over the world, but I do think the dynamic of the workplace is like changing,
Yeah.
and I
Yeah.
just wonder, I don't know, it's like a very vulnerable, but I'm like, will there still be a place for 67-year-old Katie, like in the workplace when,
Mm.
I'm a little nervous. That's why I'm like, maybe I should learn to bake and open a little bakery. Everyone always likes muffins. I don't know. I'm joking in the last part, but yes, I agree. It is hard to determine what will I need. Yeah, I have no idea.
Yeah.
Why do you think your daughter's going to
Um,
want to move to the West Coast? Is she is she
uh,
showing signs of wanting like being a budding actress?
she's high drama.
Oh, fun.
No, no, I think it's just because I'm like, I just think about like scenarios. And for me, that's like a worst case scenario just because like I
Hmm.
wouldn't want her to move far away. But I mean, I think I just, the type of parents we are, we're very like, we'll just be where you are kind of thing. And so, I've also, I mean, I'm sort of living through it right now
Mm,
where we've got her and she's 3 years old and I have my parents are in different places. Like my mother's down south and my father's down south but in a different state. We've got kind of family spread out
hmm.
and her parents are up north, so it's like we're not all in one place. And
Hmm.
you kind of, that whole idea of like a daily life, nuclear family, it's not, that's not it for us. And so I kind of think about that a little bit, and you know it kind of influences my decision making about that. So it's stuff like that. I'm not sure. I'm not sure. Like I've really thought through how this will all go down, but
Hmm.
I in terms of finances, I think about how much prices have risen just in my life,
Hmm.
and how much prices will rise now in her life. And then when I try to calculate my number for, okay, this is how much we're going to need to retire,
Hmm.
I I think it's probably wrong. Like like I have this feeling that it's way too low, and that, it'll be very difficult to be able to like have flexibility and freedom to move about and maybe replant ourselves in a different area of the country.
Hmm.
Um I don't know. Maybe I'm just high anxiety, not sure.
No, I feel like, but given like our generation, we're the first generation that's like not doing as well as our parents, or as the previous
Mm-hmm.
generation in terms of salary at specific ages, or people using the metric of like people buying homes or having the ability to buy homes. So like I feel like it's warranted. Like I feel the same way. That's why it's kind of hard to say 25 years from now. Who knows?
Mm-hmm.
Who knows?
Yeah. Well, either way, I'm super proud of you because you've
I'm
got
super proud of you.
you've. Yeah. Well, I've talked to a lot of people, and I've noticed that, I mean, just the act of investing beyond the 401k is not something that everyone's doing, and just the simple fact that you're doing that, I'm like, I applaud you for doing it.
Yay.
I hope you keep it up, and I hope you even lean in further, because I think that's gonna change your outlook in the future.
That's the hope.
Yeah.
Yeah.
So the only other thing I was gonna tell you is so there's this thing called the optimal order for investing, and it's just about like the sort of sequence in which you should invest in which type of accounts. And so it's like they want you to invest in your 401k, and you're supposed to have kind of already taken care of maybe some high interest debt if possible, if it's like super high interest.
Mm-hmm.
But if you just sort of fast forward to the investing portion, it's like they want you to take care of your 401k. And what they'll typically recommend is that you just get the match, like get 100% of that match first. And the reason they suggest that is because it's like free money.
Yeah.
Right? Like
You guys
you're
gonna
getting
get like
100% return.
Get that match.
Get that match.
That could be your
And then that could be get that
your
match.
motto. I mean,
Yeah. And then so they say, okay, once you've gotten your match on your 401k, they tell you to then look at like an HSA, because then the HSA is like triple tax advantage. You can do pre-tax dollars, and then it grows tax free, and then you can withdraw the contributions and earnings for medical expenses, and it's tax free if it's so long as it's unqualified medical expenses. So that's sort of one of those order of operations things. And then you've got the Roth IRA, which it sounds like you're doing. And the Roth IRA, I don't know if you know this, but you can actually pull out the contributions at any time.
I did not.
I'm not sure if you know that.
No.
So like it's weird because it's a retirement account, but you actually don't get penalized for pulling out the contributions of your Roth IRA. You can do that at any time. You will get penalized if you try to pull out the earnings. Yeah. Yeah. So a lot of people do use them. I wouldn't recommend this, but a lot of people do use them as like when they need, like they're like strapped and they need money, they can pull out of those. And then after you've done your Roth IRA, some people will then suggest that you go back and you max out your 401k to the IRS maximum.
Say that last one. You max out your what?
You max out your 401k to the IRS maximum. So
okay.
To the 22, it's like in year 2023, it's $22,500. And then they say, if you have money left over after that, then you can think about a taxable account. And the only reason they have this optimal order of investing is because it's meant to optimize your tax situation. To me, I don't know if I buy into the whole order so deeply that like that's a must. There's different things, right? Like you have your 401k and you can't touch that, right? So like if you max out your 401k, all that money's just locked up, right? Whereas with your situation, you're putting it into a taxable account, so you can access that money at any time. You might pay capital gains on, some short-term stuff or some long-term stuff, but you might pay money on dividends. You might pay money on interest. But if you're willing to kind of assume that stuff, then it's not a problem. Does that make sense?
It does. I guess my question was going to be, So we're waiting to the very end to do taxable. What if, so, and like right now, I mean, I do some of the above, but,
Mm-hmm.
so are they basically saying like in your taxable, if you wanted to do short term, like kind of higher risk or whatever, like stocks, um, basically choosing products in your 401ks that would mirror kind of like what I'm doing in my Wealthfront, basically. So taking my Wealthfront stuff and then just putting that into like a 401k.
Yeah. So, what people typically do, and I mean, this is going to get a little bit more weedy, but what
Mm-hmm.
people typically do is they use the order of operations, like I mentioned, and if they get to a taxable account, they make sure that it's tax efficient. So I'll say it like this: when you invest, you have tax exposure to a few things. One, dividends. So you invest in companies, certain companies pay dividends that comes out of their profits, and they pass it on to shareholders. You get money just like cash. Most people try to reinvest their dividends. Some people pocket them. Some people really want to live off their dividends. There's like a whole thing about dividend income investing that people, it's wild. People like are literally trying to live off of their dividends. But in essence, when you get paid a dividend, you pay taxes on it. It counts as ordinary income. There's no advantage from a tax standpoint when you get paid a dividend. You also can get paid interest when you have stocks. So you just like any sort of banking account or savings account, you can earn interest. You can also be paid distributions, which can count as like long-term capital gains. You can also run into short-term capital gains, etc., and that's taxed in certain ways. So the point is that when you have a taxable account, all those things can hit you from a tax perspective. So at the end of the year, you get you log into Wealthfront, they furnish you a 1099 div, which is your dividends, a 1099 INT, which is your interest, etc. So like you'll see all of this every year, and you'll see how much you were forced to pay. That's why their tax loss harvesting feature is awesome, because they're offsetting the total tax bill that you're going to get levied against you in your taxable account by doing the tax loss harvesting.
Mm-hmm.
So if you were to look at your sort of tax burden, you'd be able to tell over the past, since 2019, have they been able to basically stop you from having to pay taxes on your portfolio because of how much they are doing for you on a tax loss harvesting basis. And the reason that it's so important is because in any one given year, nobody cares about it. But if you look at it over time, like if you're investing for 30 years, and let's just say you're paying $3,000 in taxes every year, and it's actually growing every year because your portfolio is growing every year. If you look back, you've lost maybe $100,000 or something. You know what I mean? Like you've lost a lot of money. And so people try to be as rigorous as possible about that. And so when you invest in a Roth IRA, for example, let's say you were to pick a stock that yielded dividends. There are even ETFs that yield very high dividends. You don't have to worry about getting paid a ton of dividends, because when you get paid those dividends, you don't pay taxes on them because all of your earnings are tax-free in a Roth IRA.
But you have to
so
wait,
what ends up
right?
happening?
You have to wait till you're 67.
You would still have to wait. Yep. You would still have to wait until you're at retirement age to pull out it's a long time away. But your money's growing tax-free. And it's a big deal because there are these things called required minimum distributions. So like when you have your 401k, when you hit age 72, they force you to take out your money. Like they're not going to just like let you sit with all this money.
Yeah.
So they force you to take out and exhaust your portfolio. With a Roth IRA, there are no required minimum distributions. So if you had enough, like let's just say you had enough in dividends that were coming to you and your expenses were low enough, you could potentially live off of dividends and maybe sell just a small 1%, 2% of your portfolio and live off of all that and have it continue to just grow and grow and grow until you're dead. Like that's what people do, especially wealthy people. They pass these things on to, beneficiaries. So, it's up to you. It's up to you how you want to handle your situation. I do think that there's merit in investing in a taxable account because it's so flexible, right? Like you said, you pulled it out earlier to use it for your house, right? You could potentially do that again. I think that makes a ton of sense. So I was just letting you know that there is this thing called the optimal order. Some people call it the order of operations for investing. I was just saying you should look into it, just research it, just so you know about it.
I love
and
it.
then maybe you can figure out how it sort of meshes with your style and your needs.
I will. Thank you.
I just want to ask you, do you have any message for people out there about any of this that you would just say? Or are you?
Yes.
Okay.
Well, okay. So when I first learned about the podcast and the premise, I think it's genius. I would love for more people to more openly share about what they're learning, exactly what we're doing right now and today, like what you've learned, what your journey is. I feel like investing is sort of like this scary other language that only smart financial white men know about, or Mike Sanchez. And I love that you are doing this. It makes it feel so much more accessible. So I guess, my message would be, don't be scared to get out there and ask questions and try new things and stumble around like me.
I really appreciate you taking the time and having the bravery to do this. I know it's not easy to talk about money, and especially the kind of personal things that we do with it. So I really do thank you, Katie, and
love what you're
I appreciate
doing.
you.
I appreciate you.